So what exactly happened? Hi guys, it's Eric from Hong Kong based in Germany. I've been investing since I was 17 years old for almost 20 years. I want to give you guys alternative perspective about investment related to Asia. Today I want to talk about the worst sell-off of Chinese shares listed in the US since 2008 financial crisis. ARK Invest, for example, sold off their shares in Alibaba, Tencent and BYD. ARK Next Generation Internet ETFs also saw their holdings of Chinese companies from 9% down to 3.8% within a few months' time. So what exactly happened and what should we do? So what exactly happened? Many of you probably heard about the crackdown on education companies and on Tencent Music, but probably you have no idea about what's happening with WeChat, which has more than 1 billion users in China. It's not even covered by the Western media, and I'm going to talk about it later. If you are new to the topics, I've made a number of videos on regulations in China, especially on Didi, on BYD, and on Alibaba. You can check out the link above so that you have background information about what's happening in the past few weeks and past few months. Nasdaq Golden Dragon China Index fell 15% in just 2 days. It fell 45% since February. And you need to understand that it tracks 98 biggest Chinese stocks listed in the US, so we are not talking about one share. The latest trigger is that education companies become the target of regulatory crackdowns in China, after big technology companies like Alibaba being propped on antitrust behaviors, or like Didi being propped on data security. And it is much harsher. For example, companies providing tutoring in curriculum taught in school will be forced to register as non-profit organizations. They cannot raise money in the capital market. Other listed companies are not allowed to invest in them, and even worse so is that foreign capital are not allowed to invest in this kind of companies. Well, basically we are not allowed to invest in education companies in China. But what's the point of investing if they cannot make money at all? Of course, the share price of education companies crashed. TAL Education Group, for example, fell 70% in 1 day. Gaotu Tech Ed fell as far as 63% in 1 day, and both of them are listed in New York. Okay, you may say, why is it related to other Chinese stocks? Why are they crashing? Because this implies that the Chinese regulatory crackdown is much beyond the scope than anyone expected. It could be any industries, it could be very random, it is unpredictable, and people just can't help but to sell in panic. It is not specific enough to technology companies in China. Look at Tencent Music. They have been ordered to give up their exclusive streaming rights of music in China within 30 days. This including with Universal Music, Sony Music, etc. You need to understand that they own 80% of the streaming rights in China, and this is a big thing. It is a bit like Netflix spent millions and millions of dollars in exclusive rights of many movies, and now the government say, oh no, sorry, you need to cancel this contract within 30 days. And then all kinds of exclusive movies be now open to Amazon and Disney and the likes. But this is not the most dramatic. Meituan, the biggest food delivery company in China, fell 18% in 1 day in Hong Kong Stock Exchange. So what exactly happened? This is because 7 government agencies jointly issue a guidance regarding the rights of the food delivery workers. That's why the stock prices of this kind of companies are no longer just judged by basic financials or growth figures. They are factors beyond numbers. That's also why you need to have alternative perspective about the Asian stocks, not just the numbers. Subscribe now, even better to click the bell button next to the subscribe button so that you're not going to miss out my latest analysis. Okay, back to the topic. The most shocking of all is actually not covered by the Western media, about WeChat, which is owned by Tencent. It has 1.24 billion users. Yes, billion. Monthly active users. They are not accepting new registration of users. The official reason is that they are just fixing it for some technical problems. But of course the real reason reported by many Hong Kong media is that actually they're not sure what the regulators would do next. So just to fly below the radar and play safe. This shows that the crackdown has sent stock waves across the board of Chinese technology companies. They simply do not know what the regulators would be attacking next. They rather to hold the growth potential for now. And of course, the valuation would go down as well. Okay, Eric. So what should we do then? First of all, lesson number 1, we should always learn to cut loss even before investing. It could be 8 to 12% depending on your risk appetite or some kind of thresholds from technical analysis. You need to know that a drop of 50% of a stock requires them to go up 100% in order to recover to the original position. So this is very important to learn. Okay, you may say that I already bought it and I didn't cut loss. What should I do? Well, of course, I myself learned it the painful way in the past as well. What you have to do now is good news. It's probably going to rebound a little bit. Every time it rebounds, I think you should sell them at a lower loss. Better to preserve your cash and relocate the cash to buy 1 or 2 companies that you believe is really going to rebound a lot. For example, Meituan. Because Meituan fell 18% in just one day. But actually all the regulatory props more or less come out. You know what is the requirement. And the latest one is actually on accident insurance, which costs only 0.7 US cent per deal. So I don't think they are going to go down a lot much more. However, you need to be cautious because the whole market of Chinese technology companies are falling. So of course you're not going to buy immediately when it's going down. In terms of timeline, one of the government agencies gave us a little bit of insights. They claimed that it would take 6 months to finish the investigation. So expect roller coaster in the coming few months. So for short term, as I mentioned, I personally would sell some of the stocks as less losses and then I will relocate them to the big companies that I think will recover sooner. For example, Meituan. For long term, if you're looking for at least 10 to 15 years, then of course you can follow Charlie Munger to buy in maybe Alibaba and BYD, this kind of leading companies. But be patient and expect that the growth rate will be lower than before because of the regulatory changes. But after all, the long-term perspective of China is still the same. It is still going to grow and it's not changing anytime soon. So what kind of topics do you like me to talk about? Leave me in the comments below. If you like the video, remember to like, share and subscribe. Even better, clicking the bell button next to the subscribe button so that you're not going to miss out. It would be great motivation for me to making better videos for you guys.